Here's something that might surprise you. While everyone's talking about economic uncertainty, Texas is still projected to add over 200,000 jobs this year. But here's where it gets controversial. The growth is slowing down in ways that could signal bigger changes ahead. The latest Texas employment forecast, released on August 15th, paints a picture that's both optimistic and cautionary. Economic analysts are predicting that the Lone Star State will see job growth of 1.5% throughout 2025, though they're keeping their confidence relatively measured, with a range between 1.1 and 1.9%. What economists call an 80% confidence band, essentially meaning they're fairly certain the actual number will fall somewhere in that range. To put this in perspective for those unfamiliar with economic forecasting, this prediction isn't just pulled from thin air. It's built on the foundation of 4 sophisticated economic models that carefully analyze projected U.S. gross domestic product growth, oil futures pricing, and both Texas-specific and national leading economic indicators. Think of these models as highly educated crystal balls that crunch massive amounts of data to peer into the economic future. The numbers tell an interesting story. Texas is expected to welcome approximately 208,300 new jobs by year's end, pushing total employment to a robust 14.4 million workers by December 2025. For the remaining months of this year, growth is anticipated to continue at a pace of 1.3%. But here's where things get complicated, and this is the part most people miss when they just look at the headline numbers. July's employment data revealed some concerning trends beneath the surface. While Texas did add 10,500 jobs with an annualized growth rate of 0.9%, June's numbers had to be revised downward to a negative 1.6%. That's economists speak for, we initially thought things were better than they actually were. Luis Torres, a senior business economist at the Dallas Fed, didn't mince words about what's happening. Employment growth seems to be softening and is on a slower trajectory for the second half of the year. Torres pointed out something that should make Texans pay attention. The state's year-to-date job growth of 1.6% is falling short of its typical long-term trend of 2.0%. And this is where the story becomes particularly interesting for different industries and regions across Texas. The manufacturing sector and oil and gas industry, 2 pillars of the Texas economy, are actually leading this slowdown, experiencing 2 consecutive months of job losses. Meanwhile, education and health services, which had been performing solidly, unexpectedly reversed direction and shed jobs in July. However, it wasn't all doom and gloom, as other sectors managed to post gains. Geographically, the employment picture varies dramatically across major Texas metropolitan areas. San Antonio emerged as the star performer among major Texas cities, while Houston, traditionally a powerhouse, has now experienced employment declines for 3 straight months. This raises some thought-provoking questions about regional economic resilience and diversification. The Texas Leading Index, which economists use as a predictor of future economic activity, showed improvement over the 3-month period ending in July, but the details reveal a mixed bag of indicators. Positive contributors included improvements in average weekly hours worked and the Help Wanted Index, indicating more job openings, along with decreases in new unemployment claims and favorable changes in the Texas dollar's value. However, these gains were partially offset by declines in the U.S. Leading Index, Texas stock performance, oil drilling permits, and real oil prices. For those wondering how these forecasts are actually created, the methodology is quite sophisticated. The Dallas Fed doesn't rely on just one approach, but instead averages results from 4 different economic models. 3 of these use a statistical technique called vector autoregression, which examines how Texas employment relates to historical patterns in West Texas intermediate oil prices, U.S. leading indicators, and Texas-specific leading indicators. The 4th model takes a different approach, looking at how current employment levels relate to past employment, U.S. GDP growth, oil prices, and even included COVID-19 hospitalization data through March 2023 to account for pandemic effects. To ensure accuracy, these models incorporate forecasts of U.S. GDP growth from blue-chip economic indicators and oil price futures, while also including adjustments for the extraordinary circumstances of March through June 2020 when COVID-19 first hit. The next update to this forecast is scheduled for September 19, 2025, which will provide fresh insights into whether these trends are continuing or if Texas employment patterns are shifting once again. Now, here's what I find most intriguing about all this data, and tell me if you agree or disagree. Are we witnessing a natural economic adjustment, or are these slowdown signals pointing to deeper structural changes in the Texas economy? Is the decline in traditional sectors like oil and gas and manufacturing actually a healthy sign of economic diversification? Or should Texans be concerned about losing their competitive edge in these industries? And here's the controversial question that economists are quietly debating. Given that these forecasts are based heavily on oil prices and U.S. economic performance, how reliable can they really be in an era of rapid technological change and geopolitical uncertainty? Are we putting too much faith in models that might not capture the full complexity of today's economic landscape? What's your take on these employment trends? Do you see the slowdown in manufacturing and oil and gas as a temporary blip, or a sign that Texas needs to accelerate its economic diversification? And for those in Houston, what's your perspective on 3 straight months of employment decline in your metro area? Share your thoughts and experiences in the comments below. For more detailed information about the Texas employment forecast methodology and additional research, visit the Dallas Fed's forecast page at dallasfed.org/research/forecast. Questions about this forecast can be directed to Luis Torres at luis.torres@dal.frb.org.